I just want to say from now, if you're not a spiritual person, then this video is not for you, because the level of belief and faith that you have to have in the laws of the universe already for this to actually realize any profits in your life, you're going to have some faith in something higher than yourself. So if you are not a believer of a higher power, click off this video from now. What's going on, everyone? Welcome back to another video. And in this video, I'm going to be explaining how I figured out that the laws of the universe affect the charts. So the first law that I want to talk about is the law of cause and effect. Every market move has a cause, and that leads to an effect. ICT understands that there are manipulative moves where smart money causes reactions to trap retail traders. So if we align ourselves with the universal law of cause and effect, you would understand why and where price is coming from and where it's likely to go. And something visual on the charts to show you that is a PD array. I have an example of a fair value gap as a PD array. We see 1, 2, 3 candles, and the second candle is the fair value gap. So that is price goes into this area, and we have a lower time frame view of that. It will break structure and then continue higher. The cause being the fair value gap being traded into, and the effect is a bullish move away. The law of attraction is the second law to go over, which is similar to the first law, how it shows up on the charts, but like attracts like, meaning positive or negative energies bring similar outcomes. So in markets, liquidity attracts price. The market naturally gravitates towards areas where liquidity is concentrated, such as stop losses and pending orders. The concept of liquidity pools in ICT trading reflects that law, with price magnetized towards areas where orders are clustered. And here we can see a liquidity level being tapped into, buy side of the curve activated, and price magnetized towards this old high. The third law I want to go over is the law of balance. Now this is equilibrium and disequilibrium. The markets seek balance, moving between points of fair value and points of overbought and oversold. In ICT, this shows up in the concept of premium and discount of a range. So the market trades to areas where price is either undervalued, overvalued before seeking equilibrium again. Now showing you this on the charts, we can see we have one leg from a low to high. Of course, there's smaller legs in between this, but this entire leg has a premium and discount measurement. And before price continues to its destined target, which was the old high, it came back and seeked a discount pricing before then moving to continue with its move. And understanding that definitely helps in trading. And the fourth law, there was supposed to be 3, but thank you for watching the video. If you watched it this long, if you actually understand what I'm saying, you'll be able to realize the gems. The law of correspondence. For me, this is one of the most important laws because it's one that I use very frequently, actively. So this law comes in the form of top-down analysis. So this law states that patterns repeat on different scales, much like fractals. In trading, the correspondence between time frames is key. What happens on a smaller time frame reflects on the larger time frame. So patterns seen on the daily chart are mirrored on an hourly chart, and then even the minute chart. Connecting the multi-time frame analysis using ICT is using the law of correspondence. So having faith that a daily key level will bring a lower time frame reaction, that is the law of the universe, that it has to. So if you understand that, you'd be able to know that we've tapped a daily PD array, and then know that there's going to be some form of measured move away from that point where you can get in price and make profits. In this example of top-down analysis, we can see on the left we've got our hourly chart, and on the right is like a 5-minute chart. this is the 5-minute leg low and the 5-minute leg high, and this is what it looks like on the two different time frames. So this expansion is this expansion, and this is what it looks like on the lower time frame. And the final way that the law of correspondence shows up, and the best way that it's going to affect your trading, is understanding how it shows up with the market maker models. So the same way the law of correspondence repeats as above so below, it also applies to the statement as the left so the right, meaning ICT market maker models are a reliable framework to enter off according to this law. As the left so the right, where you see a consolidation or reaccumulation on the left, we will also see one on the right. Price is symmetrical. That's why now if you see online, there's a lot of talk about inverted fair value gaps and inverted PDRAs. They've always been a thing. It's not a new concept. But when you take it and you isolate the concept, it looks like something new. But ICT has always been using the inverted and symmetrical nature of price. And I've written underneath here that says, knowing where you are inside of a market maker model gives you the consistent holy grail strategy that you're looking for. If there's one thing you're going to take from this video, it's the law of correspondence and how it shows up in market maker models. To summarize this video, your understanding of the laws, and they all show up in the charts, not just these select few that I've explained here, they all show up in the chart. I advise you to go look for them yourselves and understand how it can benefit you to know the laws and how they show up in the charts, because it is beneficial. That's why I've made this video. I hope that this has enlightened you or shed some light or gave you a different perspective on trading in general as a whole. But yeah, until the next video guys, peace.